Hello and welcome to another episode of Darwin Investors. Medic! My portfolio could really use a medic right now. I'm trying to find a good spot to be able to rebalance my portfolio, and I need it to kind of bounce up before I can do that. I'm in a lot of blue chip stocks. I don't mind holding on. And I'm a dentist by trade, so I have all the time in the world. I'm only kidding myself when I think I'm actually going to be able to retire or retire. We'll crawl out of the crypt to come and work on people's teeth. I'm sure we've all seen that before. Charlie Munger would have made a great, he might be a dentist, is Charlie, but I don't know. He'd have made a great dentist. But this video here today, this is going to be based on user comments. I made a retirement video and they made a lot of good comments there. And by the way, thanks for those and thanks for checking out the videos. And they made a lot of good comments. And I'm just basically gonna just answer user questions and that through this video right here. I told my wife, I was like, we have a video out that's doing really good. I said the retirement video, and then she's like, well, how many views have you got? And I said, well, take a guess. And she says, 100? And I'm like, no, it's got 7,000. And then she's got this look of horror. She's like, did you dress dumb? Because she thinks I dress really poorly or whatever. Like we'll leave the house and she'll look at me and she says, are you gonna wear that? And I'll be like, since you asked that way, no, I'll go change. But in any case, I thank you guys a lot for checking out the videos and giving the thumbs up and all that sort of thing. And on that note, let's go ahead and get into this. Let me share my screen and we'll get into this. All right, so what we have on tap today is, in a perfect world, how would I rebalance this portfolio? And so I'm going to talk about what signal I would give for like rebalancing my portfolio and that sort of thing, and how I would rebalance it if the opportunity ever really presented itself. If I wasn't just I'm not going to lose my shirt on my blue chip stocks. I will just hold on to them until the end of days if necessary. I got nothing but time. But I will tell you, if that does bounce, how I would rebalance it. And some of the things that might be rebalancing would be in some defensive hedges. At the moment, we see XLP and XLV. This would be a consumer staple ETF. This is a healthcare ETF. And of course, XLE is the energy ETF. And we'll talk about that. The user comments, they have a lot of questions about, like, say, JEPI versus XYLD. These are both S&P 500 covered call ETFs, both excellent in retirement. And then, or like NUSI versus QYLD, which one would, let's go into these in a little bit more in depth and see which one we would prefer to use. And these are both covered call ETFs on the NASDAQ 100. And then finally, I'm going to talk about how we got the taxes are due on Monday, and then how does tax season historically trade? Is it good, bad, indifferent? And I've got some articles that go into detail in that. So let's go ahead and get started here. So we're going to talk about demand destruction right now. And here we've got the consumer price index. And regardless of whether or not the Fed is raising rates, we're still spending less money on elective type of things, it seems. Maybe not in travel, though. It seems like we're still spending some money in travel, but when I look over this CPI summary that just came out last week, I believe, April 12th, we can see that there is a bit of demand destruction. And so what we see is that, like, food away from home, though it's up 6.9% year over year, it's come down month over month from January. And we see that, say, apparel, like where it's going up again, like we say, 6.8% over the year. But again, since this time December, obviously Christmas, but since December, it's gone down quite a bit. So buying things costs a little bit less money. So these are things that, like, we're cutting corners right now. So where we had a chip shortage not all that long ago, now I'm seeing reports where we have too many chips, and maybe not the right kind of chips to make cars and those little semiconductors, but just for the large chip manufacturers, they're saying that they're afraid we have too many. Where we had a supply chain problem not all that long ago, now they're talking about where the transports are being devalued because there's not enough demand and we have so much supply. And so these are all problems that are happening right now. So we're seeing a lot of demand crunch, destruction. So what we were seeing before was that we had not enough semiconductor chips. Remember, there was a chip shortage, and this was only about 3 weeks ago. But now all of a sudden, there are talks about there are too many chips. Maybe not the right kinds to actually build cars with, because leaving out one or two there. But by and large, just in general, they're saying that we're having like a chip overage now. It's too much supply. We're also talking about like where we had a supply chain problem. Now it's switching to these transports are getting hit because they're saying we don't have enough demand. And so we have too much supply chain at the moment. So now the transports are kind of taking a bit of a beating. And so things are kind of shifting very quickly due to demand destruction. And for that, earnings forecasts are pretty bad. And since the market's always thinking forward, so when they're saying, okay, so we expect earnings to be really bad in the next year or so. So they're discounting it now before even the earnings have come out, and they're going to enlighten us on this. And JP Morgan was a good like spotlight on this. They were like, hey, you know, things are tough out there. And so they were kind of setting the stage for, or even like giving a green light to other companies coming out and saying, hey, this year is not going to be as good as last year or the year before. And that's why the market is trading down right now. And one of the more interesting takes that I saw on this was that was when this Keith Lerner over at Truist, he says, I think you're going to see a lot more differentiation and divergences. I think you're going to see companies that have managed well and others that have profit pressures. You're going to see more extremes relative to broad-based strength over the past 2 years. Strategists expect the main market to remain volatile as the Fed Reserve prepares to raise interest rates again in early May and continue to tighten policy this year. Our broader view is we're going to be in this big, broader, choppy range, Lerner said. The way I see it for the next couple of months is no new highs and no new lows. At least no new lows is a good thing, because it's a lot of this has already been priced in. That's another reason why I don't want to sell any of my blue chips at the moment, because I feel like they've priced in an awful lot of bad news. And consequently, when the good news starts to come back, when the market starts to bounce back, it's because they're going to be anticipating better news in the future. And we might be at the lowest low, and it may seem wrong, but the market's going to bounce back. So you got to make sure that, at least I'm going to make sure that when I have my portfolio, and this does happen, that I'm positioned in a way that I'm prepared for a wicked bounce. So rather than being, say, 60-40 in some growth equities versus defensive stocks, I'm going to be more probably 70-30 or even 80-20. And then so Lerner said uncertainty about the Fed is one reason he downgraded the stock market. The whole stock market is just coming down, according to this guy, from attractive to neutral this past week. He also did it based on rising yields and the defensive positioning he sees in the stock market. And like I said, I'm going to get more defensive than I traditionally am. Usually I'm not defensive at all. Like I said, I have all the time in the world. But I'm gonna get defensive when the time comes. I've got a technical indicator that I'm gonna use, and it's pretty unconventional. You know, a lot of people like to use like the Fibonacci lines. Nothing will get me change a channel faster, by the way, than somebody throwing Fibonacci lines at me. I'm like, this is nonsense. Or like the MACD. That's probably maybe that's my least favorite indicator. It's up there. And so what they'll say is, someone will look at this chart and they'll be like, oh, you should have bought here. And then they'll look back and go, oh, and this is where you should have sold. And then this is where you should have bought. And then this is where you should have sold. And I'll be like, well, what do I do now? Well, I don't know yet. If it does this and that, and if it does that, and I'm like, yeah, well, thanks for the intel there, Nostradamus. So like, I really hate that. And the head and shoulders, I can't stand that thing too. Oh, look, it's making a nice head and shoulders pattern. I think this is a time to buy. All that stuff is ridiculous, but I don't know. It keeps us entertained, I guess. So when I'm actually, the indicator that I'm going to use, actually I will use support and resistance when trading options, like selling options and that sort of thing. I will use that. But the one I like to use is this will happen to me occasionally. Like if I have like my portfolio goes up really, really well, I will I will actually take a screenshot and send it to my wife and say, "Hey, baby, look at how good I'm doing," you know, because that kind of satisfies the most primordial hunter-gatherer instinct in me, I guess. I don't know why I do it, but I do it. And when I do it, it never fails. When I send that picture to my wife, and the next day or two, everything just comes crashing down. So that is like a highest high for me in the stock market. Or maybe you're a person who's a content creator on YouTube, and that's the day you can't wait to get back on the channel here and talk about your great victory or whatever, or you can't wait to show your portfolio. That's the time when you should probably start trimming at this point, at least what I'm going to be doing. I'm going to start trimming at this point and getting a little bit more defensive. And I'm thinking about a 70-30 range. Now, what am I gonna diversify into? Well, it's gonna be a lot of these defensive stocks that I was talking about earlier. And I'm going to just go over some of these in a little bit more detail. Now, when we do these, look at these stocks, we're going to do this in relation to the S&P 500. And because this is this is kind of like the standard bearer. It's the benchmark. It's the one that everybody says that you should go into, dollar cost average, every 2 weeks, put your money in there, so on and so on. And in the past year, it's up 5.51%. So we're going to use 5.51% as our measure of success for a certain ETF. So remember, 5.51%, and do they do better or worse than that? And so the first one we're going to look at here is XLP. And XLP is the Consumer Staples Index Fund by the Spider. And this is just a fantastic company. The more I look at their ETFs, the more I think, wow, these guys really have it dialed in. They're really good. Better, I think, better than everybody else does. And so what's a little bit different in there? So let's look at the XLP. If we look over the past year, they're up 13.37%. So they're doing twice as good as the S&P 500. Plus it's yielding a 2.29% dividend. So we're looking at about 15.7%. We look at their holdings, it's very heavily weighted in the top 10. 71% of all the holdings in XLP come from Procter & Gamble, Costco, Coca-Cola, Pepsi, and then Philip Morris and Altria and Walmart and so on. And when you look at their holdings, they don't have very many of them. And this is, I think, part of the strategy of Spider. They kind of take the wheat from the chaff, and I think that's what makes this such a great company, is that they only have 32 holdings in their entire consumer staples ETF. Only 32 holdings, and of those 32, 71% make up the top 10, because they're saying we're only going to own the best, right? We're going to own best of the best. And so when you compare that, say, to Vanguard here, now remember, XLP had a return of about 15.75% over the last year. This is 12.21 plus 2.0, so this is about 14 point, it's not bad. It's only about 1% behind the Spider one. When you look down here, now remember, it was 71% for the top 10 holdings. Vanguard does 62% of the top 10 holdings. It's all the same companies. So I was curious, how in the world, with all the same companies at roughly the same weight, was this thing returning 1% less than the Spider one? Well, here's the reason why. So when you go here and you look in their holdings at Vanguard, you're going to see they have 99 holdings. Remember, Spider only had 65 holdings. So these guys are holding 99 companies. They're spread out a little bit more, and they just, to me, don't do quite as good a job of separating things out as, say, as the Spider does. I do prefer to just take the best companies, okay? Just do that. And here's Fidelity's Consumer Staples ETF, just for another comparison here. These guys, they were up 12.29, about the same as Vanguard. Their distribution yield was quarterly about 2.19%, about the same as Vanguard. This portfolio in the top 10, about the same as Vanguard. And when you look at the number of holdings they got here, 103, about the same as Vanguard. So Fidelity and Vanguard are pretty interchangeable, and I think Spider does just a little bit better job. So another defensive holding you could do here is the XLV, and this is the healthcare ETF. And again, we're going to compare this to the 5.51% of the S&P 500, and we'll see how the healthcare ETF is done by Spider over the past year. So it's actually done 14.1%. And so you add another percent, 1.3, and again, this will be about the same as the consumer staples. Now, these are all going to be very defensive. This is what you want in an inflationary environment. This is what you want when the market is crashing. You want consumer staples, you want healthcare. Industrials aren't too bad. Utilities are great. REITs are great, and that sort of thing when you're going to get super defensive. So when we look over this one here, again, like we said, it's going to be the same story here. They got 53% in their top 10 holdings. United Health, Johnson & Johnson, Pfizer, AbbVie, Lilly, Thermo Fisher. And when you look over to see how many they've got total, they've got 65. I think 65 is what they had in their staples portfolio as well. When you look at Vanguard's here, again, it's going to be a similar type of story. Remember, XLV was up 14%. These guys are up 20%. Wow, 8.5%. So they did a lot worse. This one is not nearly as good as XLV, but why is that? Because when you look down here at their holdings, it's all the same holdings. It's United Health, Johnson & Johnson, Pfizer, AbbVie, Lilly, Thermo Fisher. It's all the same cast of characters, or is it? So remember, Spider only held 65. This one holds 443 matches. So this company here holds a lot more in their portfolio than just the 65 of XLV, but it comes at a cost. The cost is that you're throwing in things that aren't quite as good. You haven't separated the wheat from the chaff. XLV has done that for you. That's why I favor the Spider healthcare sector ETF over that of Vanguard's. And then of course the one that everybody loves right now, XLE. This thing is absolutely it's a beast, and because it's such a beast, I'm scared of it. Like, how much can this thing really run? Remember, the S&P only ran 5.51%. This thing's like 65% over the past year. It's 40% year to date. If you look at the holdings here, ExxonMobil and Chevron and Conoco make up roughly half of their portfolio. 75% are in the top 10. These things are year to date up 43%, 46%, 38%. You know, this is just unreal. Schlumberger is up 44%. Occidental up 104%. And all this to me says bubble. Maybe it's a great one. That's my 2 cents. I'll do a longer video on it, I reckon. But for now, this is one that scares me, that there's not a lot more upside to it. But maybe it's great. You know, there's only 22 companies in this one here, and the dividend yield on it is really nice at 3.29%. So I guess, you know, this is definitely one to consider, and one I sure wouldn't blame anybody for owning. And now we're going to get into the retirement stocks. And I call these retirement stocks because they're not generally going to be your growers. They're the ones that are that maybe go down in the underlying's value year over year, but you're not in it for that. You're in it for the dividend. So and I noticed in some of the comments, they'll be like, well, it's not as good as the S&P 500. Well, it depends on what you're using it for. You know, if you're using it just as a supplement your pension, or try and retire early, or you're using it to be able to just make ends meet, these are way better than the S&P 500. If you're trying to grow your portfolio, these are way worse than the S&P 500. So it all depends on what your end game is. And these are way better than bonds right now. The bond market's taken an absolute shellacking. So you want to make sure that you get out of that, unless it's the I bond market. The I bond market is something, I'll leave a link in the description, but it's something that it's capped out. It's inflation based. So right now it's at 7%, but you can only put $10,000 max in that. It's projected to go up to 9.65% after these interest rate hikes, and it takes a different kind of broker. It's got a penalty if you take out the funds a little bit early, but I'll leave a link in the description for more information on I bonds if that's something you're interested in. Again, 10,000 is the cap on that, and and it's kind of a pain in the butt there to buy. You can't just go through your broker and get those. You got to go through the government. All right, so before we get into the covered call ETFs, I'm just going to really quickly just do a very fast tutorial on what a covered call is. So we'll sell a quick covered call here. This is going to be the world's fastest covered call tutorial. So all I'll do is I go in here, I just pick an equity. In this case, I pick AMD. I sell a covered call on the stock and go to call. You just choose a date of expiration. So let's just go with the 17th of June. Let's just choose a strike price of, say, I don't know, let's make it $120. And then we sell to open. Each contract is 100 shares. I go ahead and I do an offer for $1.38. Now it's $1.38 per share, so 100 shares is $138. And so what this means is that if AMD finishes below $120 by June 17th, I get to keep my shares and they're $138. However, should AMD be $130 by June 17th, I have to sell my shares of AMD to the other contract holder for $120 a share, even though AMD is $130 a share. And that's what this is. This is a covered call contract. This is a contract that says that I will do what I say I'm going to do, and you're going to do what you're going to say you're going to do. And so in a perfect world, I would prefer that this stock end up at, say, $118. This is kind of a funny thing. What happens is you end up betting against your own stock because you don't want to lose your shares. You want to keep your shares and their money. That's the goal of this. And so that's a covered call. So when you have a covered call ETF, that would be, so this is going to be the world's quickest tutorial on how to trade covered calls. So each contract is 100 shares. So you just go over here to stock, and then you go to call because you're going to sell a covered call. That's going to be your strategy. You pick an expiration date. Let's just pick something about a month away from here. And then you pick a strike price. Let's pick, say, $105. And what we're saying is that we believe, if you are the one writing this contract, I'm saying that I believe that AMD will finish below $105 by May 13th. For that, someone thinks that it's going to fish higher, and they're going to pay me $203 to hold this contract. $203 because it's $2.03 a share times 100 shares. And so what I'm hoping for as the shareholder is I'm hoping this finishes at about $104. I get to keep my shares and their money. And what the buyer of this is hoping for is that this finishes at like $115 and they get to buy all my shares for $105. And all of this has to happen by May 13th. And that's a covered call. So the reason why these covered call ETFs do so well and they're able to pay out such a high dividend is because regardless of the outcome, they're still going to collect a premium. And then for that, we have some covered call ETFs here. And one of these would be QYLD. This is a very popular covered call ETF. And when you look at it, what it's doing is it's writing covered calls against the NASDAQ 100, and it pays a monthly dividend with an annual yield of 10.64%, or roughly 11. We can see that over the year, it's been down. The underlying stock is down 8.29%. The yield is 10.64%. So if you bought this ETF and you've owned it for a year, you'd only be up roughly 2%. But like I said, this is a retirement ETF. You don't care about the share of the underlying. All you care about is that you get that payout in February, March, April, and May at the last Friday of the month, and you're always going to get your money. And that works out to 1%. So if you own $10,000 worth of QYLD, you'll get 100%. If you own $100, if you own $100,000 of it, every month they'll pay you $1,000. And that's about the rough equivalent of what that will work out to for you. And so the one we're going to compare it to is NUSI. And the reason why we're going to compare it to NUSI, a lot of people like to compare QYLD to JEPI, but they're different because one sells covered calls against the S&P 500 and the other one does it against the NASDAQ. NUSI is the one you want to compare it to because it also sells covered calls against the NASDAQ 100, same as QYLD. Remember, QYLD had a 10% dividend. This one has an 8.65% dividend. This one over the last year has lost 15, almost 16% on the underlying. And what sets NUSI just a little bit apart is that in addition to selling covered calls against the NASDAQ, it also breaks from the covered call ETF pack by seeking to provide downside protection using protective puts. So it's buying puts also against the NASDAQ 100. And so when you look over here at its holdings, and I was saying, well, where's the puts? I don't see anything here. So I'm trying to find these puts that they're buying, and the only one I can find, they only have one. It's a very small position. It's almost here at the end. It's on the last page, and you can see that it does buy puts on it, but it's in a very small amount. But it has only 605 shares. I'm thinking and they're buying a lot of puts on this. You can see the market value of this 1.5 million. I'm not sure why it's on the last page. But in any case, it doesn't seem to be quite working out quite as well for them as, say, QYLD is, because their underlying is losing twice as much equity, and also their dividend yield is not quite as high. If of the two, I would probably go with QYLD. The one that I find that's actually performed the best over the past year is RYLD. Now, that's the one that's actually the Russell 2000 covered call. Somebody brought this up in the chat, and I was like, wow, and when I looked into it, this is really nice. And you see over the 1 year, it's only lost 4%. And so it's lost, QYLD over the last year has lost 8.29%. So it's lost less value of the underlying than the NASDAQ 100 ETF, covered call ETF. And it pays a dividend yield, which is comparable, in this case, even just a little bit more, at least today, than the one on QYLD. And so it's paying a higher dividend. And the way that this one works is they actually buy the Vanguard ETF and then sell covered calls against that. So there's only just the two holdings, the Vanguard ETF and the covered calls against it. This is a very, very, very simple ETF, but it does perform well. It's not down that much over the year. Let me see how much it's down. It's down 6% over 3 years. And so it pays a really nice dividend, and the underlying doesn't go down that much. Of these three, maybe RYLD might be the nicest of the bunch, but if I was to buy two and I want to diversify, I would probably buy some of this and some of that. And now we're going to get into the S&P 500 covered call ETFs. And that would be XYLD and JEPI. And so XYLD works exactly the same as QYLD. The only difference is that it's that for the S&P 500 covered call rather than the NASDAQ 100. So XYLD is a covered call ETF for the S&P. And so it, over the past year, instead of being down 8%, is up 3%. However, its dividend yield is not as much. So why would you own this one, though the dividend yield is a little bit less, like 1 to 2% on average, less than the QYLD or RYLD? Well, this one tends to make money on the underlying. So if you're a type of person that doesn't like to see your underlying stocks go down, maybe this is the one that you might want to side with. It's probably the one I would go with. I don't like the uneasy feeling of seeing my stocks go down all the time, despite the fact that the yield is more and I'm making more every month. Maybe this would be the one I'd kind of lean towards versus those. When you look at their holdings, again, it's all the S&P 500. When we expand this out, we can see it's got 507 matches. It's holding them all. And they're selling covered calls individually against each of these holdings, right? And so this is a really nice ETF, but to me, the one that's the best of the bunch, the one that's kind of having a golden age right now is JEPI, because this one is not only a nice retirement ETF, but it's one that's like I said, kind of having a golden age right this second. It may not be one that you want to hold prior to retirement in the future, like 8 or 9 months from now. You know, like right now I'm pounding the desk for this one here, and if I could ever clear the portfolio space, I would grab a whole bunch of this. But and I would do that now rather than wait to retirement. And maybe in 8 or 9 months that changes because none of this stuff works. But the reason why this one is so attractive right now is because, one, it does go up year over year. This one is only up another % over XYLD. Its distribution yield is 7.21%, which is, again, a little bit less than XYLD. But the reason why I like this one so much right now, at least in the going forward in the short-term future, is because the way this one works is it's selling covered calls. If you look at the top 10 portfolio holdings here, 1, 2, 3, 4, 5, 6 of the top 10 holdings are covered calls against the S&P 500. So this thing is actually, when the S&P drops, this ETF is making money because this thing is shorting the S&P 500. And then it's also very heavily weighted in other things that are working, like healthcare. Is, you can see 3 of the top 4 holdings are all in healthcare. If we go here to this portfolio, the way that this JEPI is weighted versus the S&P 500 is that it's very light in tech, it's light in financials, which is really good. When the bond market is all over the place, you don't want to be in financials because financials just can't figure out what to do. So it's underweight financials, it's overweight healthcare, it's underweight communication services, which has been an atrocity this past year. It's underweight consumer cyclical, it's overweight industrials, and it's overweight consumer staples. So this thing is shorting the S&P, overweight consumer defensive, overweight healthcare, underweight financials and tech. So this thing is kind of like living a kind of like a salad days moment right now, where it's actually a really nice stock to hold in the foreseeable future. Plus, it's about to bump up its dividend yield to 9% in the coming year. That's what's forecast. Forward yield is 9.808%. It pays variable monthly distributions, and its trailing yield is 6.67%. So this yield is coming up. So I'm really pounding the table right now on JEPI. I think this is a fantastic stock. Now, last but not least, I said we get into what does tax season do to our stocks and our holdings. Well, does tax season affect the stock market? Well, it does tend to slow down as investors withdraw money to pay their taxes, and that should be common sense. A common phenomenon for the stock market around filing time is a slump in the price of stocks. The dip doesn't typically happen until the end of tax season, which for 2022 is April 18th. It doesn't last long and usually rebounds by mid-April. And so that makes sense. We're all having to liquidate some of our stocks to pay off our tax bills. And then this would be a longer type of analysis on the stock market around tax time. And this was published in April 15th of 2019. It says stocks usually win in the week after tax day. So this is what we're hoping for. We're hoping that people are going to sell off into April 18th. And then after that, we're going to get some kind of bounce. And according to this, you do get a bounce. It says over the past 20 years, the stock market has averaged near 1% gain in the week following the federal tax deadline, and it has been higher 75% of the time. By the second week after April 15th, the S&P is up 1.5%, and that's up 75% of the time. And so it's not a guarantee. I mean, there's obviously a 25%, and maybe this is that year, who knows? There's a 25% it'll end up lower, but there's a 75% chance if history is any prologue to the future, it looks like we could be in for a good week or two, which might be a good time to maybe rebalance your portfolios. If you're not getting a little bit more defensive, this might be a good time to take advantage of that. Well, we also, like I said, have earnings coming out, and these earnings are going to have pretty poor forecasts, I'm afraid. And so it may take the stock market down even further. And so, but this is like, to me, like another harbinger of bad things to come. So Or not just like the Grim Reaper. Okay, so April seasonally is a strong month. You get increasing spending from refunds coming through. So that's probably one of the reasons why you get that bump. People are getting that refund and they start spending it, and they're going out and buying iPhones or whatever. But it's just more of a seasonal phenomena. April's a real strong month. It's the end of the 6-month stretch where returns tend to be positive. That is terrible. So this is supposed to be our heyday right now, that we're supposed to be kind of getting to the end of a 6-month stretch of really positive returns before we get to the sell in May and go away. And that's May through October. So right now we're supposed to be like pumping up our portfolios and preparing for this. And October has just basically historically been the Grim Reaper of all months. And I don't know, it's just the way it works, I guess. And so we're coming to the end of what is supposed to be our good days. And so that means that I might be staying in my stocks for quite some time. But I have no doubts, though, that if it does bounce back, I will definitely be rebalancing my portfolio, probably in a 70-30 split. I tend to stay kind of aggressive. I think that when this market bounces back, it's going to happen fairly quickly. You know, it's going to be, and it's going to be unexplainable. No one's going to know why it's coming back. It's like, why is this coming back? When you look at it, our economy, it's not really that bad. There's not like there's not a lot of unemployment. This thing could snap back anytime. All that has to happen is companies have to come out with forecasts to say, we believe next year is going to be better than this year. And that will be at the worst of times, and people won't be able to explain it. So you have to make sure that when you get there, that you're in the stocks that you want to be in when that snapback happens. And so for that reason, I'm only going to be in about a 70-30 split. That 30%, I'm thinking that I'm just going to put the whole thing into JEPI, because I think that's the ultimate hedge at the moment. And I will just do 30% JEPI. I will trim my long positions on my blue chip growth stocks when I'm giving screenshots to my wife about how well I'm doing. And that's going to be my plan going forward. So yeah, thanks again for checking in with this channel as always. And if you made it to the end, that's pretty awesome. I don't make videos very often, so when I do, they tend to be kind of long. And yeah, if you got anything out of this, yeah, please like, subscribe, hit that notification bell. And until then, we'll see you next time. Bye.